Okay. Today we're gonna deep dive into call option and why they use them. So, the first video I gave y'all a quick brief rundown of like what a stock is and what a stock option is. Today we're just gonna simply dive deep into call options. And I have my notes that I'm gonna read off of, and I'm gonna help people understand a little bit better what is a call option and again why they use. And again, bro, I don't need your funding. I just need you to fuck with me. Just come and listen to me. Take the heat. Take the information. Just receive it all and help me grow. Point me in a direction. If you know more than me, just point me to the person you learn from or point me to a mentor that you might have. That's all I'm asking. Help me get into the rooms that I'm supposed to be in. Help me be around the people I'm supposed to be around. Because not everybody want to learn this shit and do this shit. So, deep diving into call option and why they use them. And we're going to start with the call option definition. A call option is a financial contract that gives the buyer the right, but not the obligation, to purchase a specific stock or other underlying assets at a predetermined price called the strike price. Before a specific expiration date, call options are a versatile tool used by investors for a variety of purposes, ranging from speculation to hedging. I don't really like the speculation word because you can't speculate none of this shit. And you shouldn't. And if you are, that's a wrong form of trading. Anyway, that's the definition of a call option. Here's some key components of a call option. Underlying asset. The asset that the option is based on, usually a stock, an index, or ETF. I'll explain the three differences in those in a different video. This one is only about call options. The strike price. The price at which the option holder can buy the underlying asset. Expiration date. The last day by which the option can be exercised. The option to buy must be used or it expires. The premium. The price the buyer pays to purchase the call option. The premium represents the cost of the option and is paid up front. Contract size. Typically, one call option contract represents 100 shares of underlying stock. Pause. How the fuck do you get all these notes? How do you even know this shit? And why should I trust you or believe you? Because I'm saving you time on this. I've read it. I've taken all my notes. Y'all seen the first video, man. We have plenty of these. I got friends that send me some. I read different books. Calls. We're talking about options. You want to learn exactly what I'm basically about to teach you in this video? All you got to do is go read that book. Take this book, pair it with the Wall Street Trapping course. Boom. I just gave you the answer. Why investors use call options. Speculation on stock price increases. One of the primary reasons investors buy call options is to speculate on a rise in the stock price without actually buying the stock. A call option allows an investor to profit from price increases with a smaller initial investment than buying the actual stock outright. Here's an example. I even wrote an example for y'all. Suppose the stock is currently trading at 100 and an investor believes it will rise to 120 in the next 2 months. They might buy a call option with a strike price of 105, expiring in 2 months. If the stock price rises to 120, the option would be in the money, allowing the investors to buy the stock at 105, potentially selling it at the higher price of 120 or simply selling the option for profit. The key advantage is leverage. That's the key advantage here, leverage. An investor can control the same amount of stock for less capital by purchasing. An investor can control the same amount of stock for less capital by purchasing options, potentially achieving much larger returns on a percentage basis. Limited risk and high reward potential. Unlike buying stocks outright, where the maximum loss is the full value of the stock, the maximum loss with the call option is limited to the premium you pay. That's the only thing you can lose, whatever you pay for the premium. The potential upside, however, is theoretically unlimited. The potential upside, however, is theoretically unlimited since stock prices can rise significantly, offering a highly attractive risk-to-reward ratio for those who believe a stock will appreciate in value. That only comes with good companies. I'm going to help you real quick and name 7 of them. Apple, Microsoft, Google, Facebook, Tesla, Eli Lilly, Amazon. There you go. And I'm tripping. I didn't even name NVIDIA. Where are we? Risk. If the stock doesn't rise above the strike price by the expiration date, the call option will expire worthless, and the investor loses only the premium paid. Leverage. Call options allow investors to take a larger position in the market using less capital. Since one option contract typically represents 100 shares, remember I told y'all this, told you that last video. Since one option contract typically represents 100 shares, a smaller amount of money controls a larger amount of stock. Example, buying 100 shares of a stock at $100 per share would cost you $10,000. However, buying a call option on the same stock with 100 strike price might cost you only $300, depending on the stock volatility and time to expiration. The call option gives you the same upside exposure to the stock price, but at a fraction of the cost. At a fraction of the cost. Income generator. And I put in parentheses selling covered calls next to this. Income generation, selling covered call. A more conservative strategy involved call options is selling covered calls. Me personally, I've never done that. I've only bought call options and or puts. That is my experience with it. I buy them 6 months to a year, and from what I've seen, I've had better returns on that than taking my ass to work every day for a bullshit job that's just gonna get rid of me when the workflow reduce anyway. And 9 times out of 10, most of the time you don't want to go there anyway. This is a good way to hedge that, to offset it. Anyway, where were we? In this strategy, an investor who already owns a stock sells call option on the stock. The seller earned the premium from the call option, which generate income. How does it work? I wrote this shit down. How does it work? If the stock price stays below the strike price by the expiration date, the option expires worthless and the seller keeps the premium. If the stock price rises above the strike price, the seller may have to sell the stock at the strike price, limiting further gains but still locking in profit and keeping the premium earned from selling the option. This strategy works well for investors who are neutral or slightly bullish on the stock and want to generate extra income from their holdings. Now again, I have not done covered calls. Me personally, I am not well versed in covered calls. So I took notes from my dummies book, and I'm just trying to help you understand what options are. Hedging risk to the covered calls. While call options are more commonly used for speculative income generation, they also serve as a hedging tool. For example, a portfolio manager might purchase call options on a stock or an index as protection against missing out on a price rally if they hold cash or a short position. If this is an example, if an investor holds a short position, betting that the stock will fall, shorting is betting that the stock will fall. If an investor holds short position, betting that the stock will fall, but is concerned about a possible price increase, they could buy call options as a hedge. If the stock price rises, the call option gains could offset some of the losses from the short position. Boy, if I ain't just give you game, I don't know what the fuck. You ain't got time to read it, I do. Send me the books that you want to read that can help me with this. I read the motherfuckers, take notes, and get on here and give you the information. You ain't even got to worry about it. Factors influencing call option prices. The price of a call option, the premium, depends on several factors. These are the 4 factors it's going to depend on when buying your call option: intrinsic value, time value, volatility, interest rates, and dividends. Side note, the Feds have a goddamn meeting tomorrow cutting interest rates for the first time since COVID. You hate your job and you don't want to be here to support me. Cool. I'm still here to support you because I fought with you. We family. We family. Cool. Intrinsic value. The difference between the stock's current price and the options strike price. If the stock price is higher than the strike price, the call option has intrinsic value, also known as being ITM, in the money. Because it has already passed that price, is now in the money. Out the money meaning you believe, quick example, if you got a strike price of 105 and you got in at 100, that is out the money. Once it touches 105 and keep going, it becomes in the money. That's just short for you, real quick. Boom. Time value. The longer the time remaining before time value. The longer the time remaining before expiration, the more valuable the option. This is because there's more time for the stock to potentially rise, increasing the chance of your profitability. You want time on your side. 6 months to a year. I promise you, 6 months to a year is what you want. 6 months to a year is what you want. Volatility. Higher volatility increases the likelihood of significant price movements in the underlying stock, making the option more expensive. More volatile stocks lead to higher premiums for call option because of the increased reward and risk potential. Now, Nvidia, if you be watching the market, for those who are well versed in just simply seeing the market, Nvidia is one of them stocks that you'll probably have to pay a bigger premium on than a Google. Why? Because Nvidia can run $10, $15 in a day. 5, 10, 15. Google might move around $1, $2, maybe even $3 a day. on its great days. Nvidia might just take off running. They're like a damn Tesla's like that. Tesla was at 210 one day. I looked up, motherfucker. Next day it was at 230. I'm like, off of good news. I'm like, hey, but you'll be done paid a higher premium because they move like that. Interest rates and dividends. Interest rates can be affected. Interest rates can affect the cost of holding stocks, and by extensions. What the fuck? What I put right there? Oh yeah, I messed that part up. Interest rates and dividends. Interest rates can affect the cost of holding stocks, and by extensions the price of the option. Why did I put extension? Okay, moving on. Similarly, expected dividends on a stock can influence option prices, as the stock price typically drops by the dividend amount on the ex-dividend date. This is just helping you understand the dividends paired with the interest rates. Interest rates and inflation are not the same thing. Interest rates have not changed since 2021? I believe they're at 5% right now, and I believe tomorrow, as of September 18, 2024, they're supposed to be cutting it between 25 to 50 basis points. This is the first time they'll be cutting interest rates in like 3 to 4 years. So this is my first experience with the stock market during an interest rate cuts time, which is interesting because they cutting rates when unemployment is also as low as it was when COVID was going on, that's a whole nother conversation. Well, that's just me diving deep. So, key strategies involving call option. You have long call, covered call, bull call spreads, and protective calls. We're gonna go over. We're gonna talk about it. Okay. A long call. Buying a call option outright, speculating that the stock will rise significantly before expiration. I'm going to show you how to take the speculating out of that shit. That book mentioned speculation a few times. Cool, don't worry. You don't want to speculate. I'm going to help you take the speculation out of it, because there's a video that I'm have showing you these websites to use. Free. They help me. And I'm going to be posting some of my shits on TikTok, on YouTube, on Instagram. I'm going to be posting some of my results. All I'm saying is it was free. And I'm not rich. I'm just learning. I promise you I'm not rich. I am just learning and becoming profitable. Eventually, this will make me rich. Financially wise. Cool. Long calls. Buying a call option outright, speculating that the stock will rise significantly before expiration. Covered calls. Selling a call option against a stock you already own to generate income from the premiums that are paid. See, I understand it, but I ain't implemented that yet. I like what I'm doing. What you call leap options. Bull call spread. Buying one call option at a lower strike price and selling another at a higher strike price to limit potential losses while also capping gains. This strategy reduces the cost of buying calls outright. Protective calls. Buying a call option while shorting a stock, betting that the stock price will decline, as insurance in a case that the stock price unexpectedly take off. Risk of using call options. Here's your risk of doing what I'm trying to help you learn. Here's the risk of doing what I'm trying to help you learn, man. While call options provide leverage and high potential reward, they also come with risk. Loss of premium, time decay, and complexity. Loss of premium, time decay, and complexity are the three risks using options. Loss of premium. If the stock doesn't rise above the strike price by expiration, the call option becomes worthless and the buyer loses their entire premium. So for example, if you bought in at 100, your strike price is 105 and you bought it for 2 months. If within those 2 months it doesn't touch 105, the premium you've paid for that contract is just worthless. It's gone. It's out of there. There ain't shit you can do about it. It's done for. Time decay. As the expiration date approaches, the option time value decreases, which means an option can lose value even if the stock price stays flat. This is known as the theta decay, and it works against option buyers. You have delta, gamma, theta. You have basically the Greeks, and I'll break that down later. Call options, or I said call options. Here's the conclusion for today's episode. Here's a conclusion to call options and diving deep into them. Call options are a powerful tool for investors looking to benefit from risk. I messed that whole line up, boy. Hold on. Okay. Call options are a powerful tool for investors looking to benefit from rising stock prices, generating income, or manage risk. I had that all messed up. They offer leverage, limited downside, high potential returns, but they also require a deep understanding of how option works. The ability to tailor strategies to market conditions, whether through outright speculation, income generating, or hedging, makes call options versatile in the hands of a knowledgeable investor. However, the risk, particularly from time decay and volatility, should be carefully considered. Here's one thing that I was learning in my process. Don't do day trade with options. Do not. Unless you're with a group. Preferably, in my opinion, Honey Drip would be a perfect thing for swing traders. That's, if you're holding it for longer than a day, you want to do it for a week, 2 weeks, that's swing trading. The best group, if you're going to do that, you need to be having groups and mentors and people around, because then it becomes very, like, you can't predict what the stock market is going to do. You cannot predict that. There's nothing you can, I've never seen nobody predict it. You just can't predict it. And be kind of good at sometimes, but you still can't predict what's going to happen. As long as you have a lot of time on your side, you allow yourself potential for a higher risk or a higher upside gain and a lower downside risk with long-term options. 6 months to a year. You'll pay more also for the time frame you want your contracts out to be. So you might have a stock that's stock price at $100, and for a contract for 2 months, for a price to hit 105, it might cost you $300. But let's say you wanted to hold that for 6 months or 12 months, it might then cost you $1,000. But that $1,000 could very well, in less than a year, in 4 months' time, turn into $5,000 to $6,000. And if you wanted to exercise your options on that contract, you can take profit right there. You don't have to wait till the expiration is there or is coming up. Because the closer you get to expiration, the faster the market can eat away at your profits too. So, also with, this is just an extra gem, with the taxes. If you hold it for a year and a day, you pay less taxes on it when you do take your capital gains. You take it out before a year and a day, you're paying more taxes on the capital gain. It's your boy Jab. That concludes today's episode of how we're deep diving into stock call options. Like I said, I don't need you to fund me. I just want your support. Help me get into the rooms that I ain't been into. Help me meet the people that I study hard on. Meaning Ian Dunlap, Rashad and Troy. I think it's Rashad Bilal. I don't know Troy's last name. Leon Howard, 19 Keys, Aristotle Honeydrip. Like, these are the people that I want to eventually become so good at this that I'm in rooms with them. And if you've been to InvestFest, yeah, one day I end up being on their stage. So just support me. Just like the video, comment, subscribe, and turn on your notifications. I'll be good. I'll be here. I'll tell you what's going on. I ain't gonna gatekeep. I'll tell you what's going on. Don't forget me.